Let's now get more insight on how Wall Street responded to this rather surprising comments from U.S. Fed Chair Janet Yellen's press conference. We have Angela Moon, senior correspondent at Thomson Reuters in New York, connecting with us live to give us an exclusive look on how Wall Street took the news. Angela, you must have first-hand experience, if you will, on market reaction to the presser from Janet Yellen. Now, we know that the market sold off on this initially, but do tell us in detail how the atmosphere was, how the traders and investors took the news.
Well, good afternoon there, Connyoung. I have to say, today's presser was one of the most unexpected events from the U.S. Federal Reserve. The statement from the central bank's latest policy meeting was in line with market expectations, but the real surprise came from Janet Yellen's presser, which was aired about half an hour after the release of the statement. Yellen says that the central bank could start to raise interest rates around 6 months after its current asset purchase program ends. She said that the bond purchases would probably end in the fall, which means a rate reduction 6 months later would move up the timetable for the Fed's first hike, which many market participants have been expecting in the second half of 2015.
Now, Angela, that does seem like something that would take the market by surprise. What are analysts saying on Wall Street?
Well, several analysts are wondering whether her answer was an unintended slip, if you will, given the deliberately vague language of the Fed statement. But whether it is or it isn't, the reaction in financial markets was swift and sharp as prices for U.S. stocks and government bonds added to earlier losses triggered by fresh Fed forecast that shows policymakers are inclined to raise rates a bit more aggressively than they had been just a few months ago. Most top Wall Street economists, however, continue to see the first rate hike in the second half of 2006, according to a Reuters poll. So it's definitely a mixed picture, a divided picture out there.
Now, Angela, going back a step, I realize this was Janet Yellen's first press briefing as the chair of the Federal Reserve, and I think she more or less showed the world that, the Federal Reserve run by her would be a little bit different from her predecessor, Ben Bernanke. How did the investment community evaluate her first presser?
You're absolutely right. This marked the first press conference for Janet Yellen, who is really the first female chair of the Federal Reserve. The Fed holds these press conferences regularly to let the public know that the central bank is delivering on its two major tasks, which are, number one, lowering the unemployment rate so that nearly all Americans have jobs, and number two, controlling inflation to make sure you're basically not paying too much at the supermarket. It was historic enough to see a woman deliver the official diagnosis of the U.S. economy. Yet, Yellen's first policy statement was historic for another major reason, which is that she shows that she's running a very different kind of Federal Reserve than the one Ben Bernanke ran before. Unlike Bernanke, who often catered to Wall Street's fears, this new Federal Reserve appears to be reluctant to play the, quote, the usual game. It was clear that under her rules, the Fed is stepping away from its reputation as a bunch of economists eager to please the crowd on trading floors. The best example came when Yellen wiped away one lazy way of measuring the economy's health. The Fed under Bernanke promised that when the unemployment rate hit 6.5%, the central bank would raise interest rates. This was called quantitative guidance, and it fed Wall Street's fetish for largely made-up numbers. But Yellen basically shut down the argument, saying that the Fed will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures, and inflation expectations, as well as readings on financial developments, sort of giving a new definition to what qualifies as, quote, quantitative guidance.
So basically, no more slack-offs, all right? Angela Moon, senior Wall Street correspondent, Thomson Reuters, New York. Thank you, Angela, for joining us to deliver us the very latest on Wall Street.